Good morning, everyone. My name is Jeff Kanij. I'm the editor of NJBIZ. Welcome to our discussion of tax reform and estate planning, otherwise known as death and taxes, the universal certainties. Although really, the events of the last 12 to 14 months have created a lot of uncertainty in these areas. The 2017 tax law, the Wayfair decision in particular, have raised a whole host of issues. Some of the rules and interpretations we've seen since then have provided clarity in some cases, in others not so much. This morning, we're going to try to come down on the clarity side of the ledger, which is why we're pleased that Ralph Thomas will be leading our discussion. Mr. Thomas is the president and executive director and CEO of the New Jersey Society of Certified Public Accountants. He's a former vice president and region audit head for Citibank. He's also held accounting positions at AT&T, Potomac Electric, and Price Waterhouse. And he has a long list of accomplishments and accolades. I'll just hit a couple of highlights. He's a lifetime member and former chapter and national president of the National Association of Black Accountants. He serves on the accounting advisory boards of several colleges and universities, including Rutgers, Lehigh, and Montclair State. And for the last 8 years, Accounting Today has named him as one of the 100 most influential people in accounting. Clearly, we are in good hands this morning. And with that, I will turn it over to Ralph, who will introduce our panel and get things going. Mr. Thomas, it's all yours.
Thank you, Jeff. I'm going to ask you to come along when it's time for my compensation review so that you can. I'm really excited to be here because, I live and breathe taxes and the old accounting stuff because I have nothing else to do. And it has truly been an interesting period over the last, I would say, 2 years leading up to all of this. So, as Jeff mentioned, I'm Ralph Albert Thomas. I'm CEO and executive director of the New Jersey Society of Certified Public Accountants, which is based in Roseland. So I have about 15,000 bosses here in New Jersey, all the CPAs that are licensed and have active licenses here. Over the past few years, I've been privileged to moderate several of these things, and I had an interesting year last year with being asked to be on the Sweeney Special Economic Fiscal Policy and Economic Review team, which started in about February of 2018 and lasted through August of 2018 to come up with some recommendations about what else, how to turn around New Jersey. So if you haven't had a chance, go out on the internet and look at the Path to Progress report that was generated by this group. I think there's some interesting recommendations there that make a lot of sense in terms of how we can possibly get New Jersey back to a space that it was probably 15 to 20 years ago, or some semblance of it. As our governor says, New Jersey will always probably be a high tax state, but how do we kind of pare that down? But so it's been an interesting landscape, and we are very privileged today to have a nice panel of experts to talk with us. And I'll just, 2018 was really an interesting year as a result of the President Trump signing in 2017, December 22nd. I have it embroiled in my mind. The Tax Cuts and Jobs Act, which reduced tax rates for businesses and individuals, but limited for state and local income taxes, better known as SALT, and property taxes, a big hit on states like New Jersey, California, New York, Maryland, you name it, that have high property taxes or high taxes in those states. And there were other regulations in that tax act which it was the most significant tax reform act since, I believe, dating back to when Ronald Reagan was president in 1986. Am I right, Paul? I think that everything else between that has been a little dibs and dabs here, but this was a major reform for on the tax code. And so there are many, many things that, one could sit up here and talk about. We could be here all day if you had the opportunity to do that. But I think the next hour, talking about this subject will be interesting. Everybody complains about taxes here in New Jersey. Anybody out here like the tax structure in New Jersey? Okay. If you did, I was going to ask you to, we'll get some help for you outside there. So let's get started, because I think we're going to have an interesting time period. So you've got notepads on your desk, so that if you have questions or whatever, jot them down as the panelists go through. So I will stop and ask each of our panelists to introduce themselves and give a little bit of your background, and then after that, we will get into the thick of things. So I'll start with you.
Thank you. My name is Paula Ferreira. I'm a partner at Mazars USA in the Entrepreneurial Business Services Group. That's a long way to say it's medium to sized businesses, about 5 to 50 million in sales is my average client. Manufacturers to professional services, distributors, pretty much I run the gamut with those types of clients. I always say that it's sophisticated hand-holding because I have a constant communication with a lot of my clients, and we speak to each other on a regular basis, especially with this new tax law. My background is definitely more of a tax background. I received my master's in tax from Rutgers and also my undergraduate from Rutgers more years ago than I would like to count. I've been with Mazars USA for 15 years now. We have offices primarily in the Northeast, but around the U.S., and also we have partners in over 80 countries right now.
And Scott,
yes,
if you would give a little bit of your background.
Thank you. Good morning. I'm Scott Novak. I'm a tax lawyer at a firm called Polak in Roseland. We're in the same building,
Yes.
Coincidentally. I've been a tax lawyer for quite a number of years. I got an accounting degree from Fairleigh Dickinson, a law degree from Temple University, and then an advanced tax law degree from NYU. Most of my work involves what we call tax controversy, which means people who have big problems with the IRS, people and companies that have big problems with the IRS, state of New Jersey, state of New York. I've done state of California with a side in estate planning. So I do a lot of speaking to accountants, and I'm happy to be here today. Thank you.
Scott, I didn't hear you say CPA in there. So you're not a CPA?
I am not a CPA.
Well, we can still work on that. It's never too late. Never too late. We need more folks, to get those credentials after. So, Brian, if you would.
Sure. I also don't have a CPA.
We can still work. We can work on that. It's never too late.
So I'm Brian Silikovitz. I'm a tax lawyer, partner at Lowenstein Sandler. Our New Jersey office, where I spend most of the time, is also in Roseland. I also work out of the New York City office. We have about 300 lawyers. My practice is mostly in transactional tax, selling of businesses. We also do a lot of work with technology startups, which are often businesses that are being formed with the desire to be sold rather than to grow and just run it for 30 years. And so the context in which I've been looking at the new tax law for the last year has been mostly in that context, and I'll be able to talk about that today.
Okay. Before we jump into our first question, I just want, how many of you know where New Jersey ranks from a tax rate standpoint? Everybody? Let me set the rate. It is ranked the worst in the country, and has been for a number of years. And just 11 days ago, about 2 weeks before the start of tax season, the IRS finally issued regulations and guidance implementing the new qualified business income deduction, which I'm sure panelists will get in. That's very interesting. And the infamous Section 199A deduction. So let's kick this off, and I'll throw this out to our panelists, and you can. Which specific areas of tax reform have your clients been expressing the most concern about? Paula, we'll start with you.
Sure. I think the item that I have heard the most talked about, of course, is SALT, state and local taxes, especially in New Jersey, the state that we live in. Everything I hear is we now can't take more than $10,000, and most people in the state, have in excess of that just in their real estate taxes alone, not counting their income taxes. So that would probably be the number one item that I've heard. Additionally, the corporate income tax rate reduction, interest limitation, and meals and entertainment, the changes to that particular code section. specifically impacted a lot of my clients. They had questions on, now I can't take any of my prospects out to dinner. They were very concerned, about the deductibility of those items. Those are the factors that I've seen the most impacted.
Scott, any additional ones that you've heard concerns echoed by your clients?
Yes, I would have to say that, again, the number one thing that I've heard about is the $10,000 limit on state and local taxes, but also the new pass-through deduction on income, which we'll speak about in a little while, has been on people's minds quite a bit. There's some misunderstanding about what it is and what it isn't. One of the things, just because of the work that I do, that I've heard quite a bit about is divorce. Will my alimony payments be deductible and thus taxable on the other side or not? What is changing with that? Those are the things that I've heard about the most.
And Brian, it's always tough to be last, but what are you hearing?
I'll echo one thing. Yeah, I think I've heard a lot, and especially early in the year after the law was new, about choice of entity. Should I be a corporation now? Should my business be a corporation because the corporate tax rate has come down so low? So the interaction of the corporate tax rate going down with the Section 199A new rules for pass-through deductions and how that affects rates for pass-throughs, that we had a lot of discussion with clients about that, and I'm sure we'll get into that and what how does it affect what entity your business should be.
So since, Brian, you brought that out, why don't we just go right to that? And are clients asking you which is better for their business, a C Corp or an S Corp?
Yes, or an LLC. I mean, I think that and I'll put this in the context of, a lot of the businesses that are asking this have been businesses that they're at our firm because they're in a certain industry where they may be the type of business that might be sold. And so I'll just give the overview of what I've been telling people, and I think others can have more detail. What I've generally been telling people is that if you would have been an LLC under the old rules, you probably should still be one. If you would have been a C Corp under the old rules, you probably should still be one. But that's a big probably, right? So issues being, and the way I look at it is, how are you going to make your money from this business? Are you going to make your money because you're going to run it for 10, 20, 30 years and pull the profits out? Or, like with a lot of our companies, our clients that are tech startups, are you going to make your money because you're going to sell the business in a few years? You may never make a profit before you sell it. You're essentially building a technology that somebody wants. And so if your plan is you're going to run a profitable business and run it for many years, and you want to pull out the profits for the owners, while the tax rate on those profits now is higher as pass-through because the corporate tax rate's 21%. If you ran your business in a C corporation, you would have a second level of tax when the money comes out as a dividend to the shareholders. And you have to weigh that with many or maybe most types of businesses will be able to get the 199A deduction. And so what that means is that the pass-through rate, the highest pass-through rate is a little under 30%. The double tax with C Corps is closer to 40, even with the 21% corporate rate. And so for most businesses, it probably still makes sense to be a pass-through, which could be an S Corp also. But some caveats to that. If your business doesn't get the 199A deduction, and you guys can talk more about who gets that, then if you're at the highest tax rate, your overall tax might be the same or similar to the double tax in C corporation form. So you have to weigh those things. I would say, though, that if you're thinking about selling the business, even if you would get or would not get the deduction, the 199A deduction, it might make sense to be an LLC or an S Corp because a buyer of your business might want to buy assets. And when a business sells assets, most of the gain is long-term capital gain and is not subject to the regular higher ordinary income rates. And so that being a C corporation and selling assets when you sell your business could subject the overall tax rate for federal to like 40%, whereas if you were an LLC or an S corp, you could sell your business with rates something in the 20s. And so the other thing that I will just throw out there, throwing out a lot of stuff, is if you're a business that you expect is going to be sold in the near term, being a C corp may make a lot of sense. If you're not taking out profits, if you're a technology startup business that is not going to pay out profits, but you're going to be sold, and you're in an industry where a buyer would be okay buying stock rather than assets, being a C corp and selling stock could be very beneficial because of something called qualified small business stock. Certain types of small businesses that have gross assets of under $50 million, when stock is issued, if the stock is held for more than 5 years and a lot of other qualifications are met, can have a 100% exclusion on all or a lot of the gain. And so the choice of entity decision can be fairly complex in this way. I mean, a lot of times businesses are starting up and you don't have a lot of money for legal advice or accounting advice, and just say, well, let's just form an LLC. The decision that you make early on could make a big difference, and it has been complicated by the change in rates and the 199A deduction. So I'll throw that out as an introduction, and maybe you guys can give more details on 199A.
Scott, why don't we ask you to speak on your thoughts on 199A and what you're hearing?
All right. 199A, which is very complex. It's hundreds of pages of regulation at this point, but I'm going to make it very simple. It's called a qualified business income deduction. So if you have income in a pass-through entity, what's a pass-through entity? An LLC, an S corporation, or a partnership. This does not apply to employees, does not apply to C corporations. It allows for a potential deduction against your qualified business income. Now, I need you to write down a number. I'm going to give you two numbers, but I only need you to write down one. If you are single, write down the number 160,700. If you are married and you file jointly, please write down the number 321,400. Those are very important numbers for 199A. Those are the 2019, what we call threshold amounts. Whether you hit that threshold as taxable income on your return or not is going to make all the difference in the world relative to 199A. If you are under the threshold and you have a business that, again, is an LLC, a partnership, or an S corporation, you can take a 20% discount against your qualified business income. So let's just say your business income to make it simple. The only limitation is it can't be more than 20% of the taxable income on your return. So that is if you are below that threshold amount that I gave you. There are no other limitations. However, if you hit the threshold, now there are a bunch of limitations. For example, there are certain businesses, types of businesses, that cannot get the deduction. Let me tell you what they are. I'm going to tell you very generally because the regulations get really specific. If you are in the health, law, accounting, actuarial science, performing arts, consulting, athletics, financial services, brokerage services, investment and investment management, trading, dealing in securities, partnership, interest, or commodities, Those are businesses that if you hit the threshold, you cannot take this deduction. I want you to know that a carve-out for two businesses that are allowed to take the deduction are architects and engineers. They had a better lobbyist than all of us had.
I thought the attorneys had better lobbyists.
No one likes the attorneys. Now, if you are in a different type of business other than the ones that I just mentioned, you can take that deduction. However, there are a couple of more limitations, not to get too far into the weeds, based on the amount of wages that the business pays. You also look at wages versus assets that the company owns for these limitations. And again, I'm happy to go into more detail about the limitations, but for now, let's leave it there. But you are entitled to this 20% discount, which is what is causing a lot of people to think through the type of entity that they ought to be. Let me give you one example. I didn't tell you much about the limitations, but one example that was in the regulations when they first came out I thought was very interesting. Take someone who earns quite a bit of money, so they're over the threshold amount, and owns land that are parking lots at airports. Brings in a lot of money for the parking lots at airports. And that person comes to one of us and says, gee, this 199A deduction, can I use it? Well, they're over the threshold, so we have to look at some of these limitations. Pays no wages, person owns parking lots, they're rented out, doesn't have to pay anybody to do anything. And it's not a depreciable asset. You can't depreciate land. If there were buildings on it, you could depreciate the buildings. But because this individual has neither wages that he pays out of the company or has a depreciable asset, his 199A deduction is zero. So these are limitations that you have to look at very carefully. And one of the things that I've been telling people, it's a commercial for you guys, is if you've never been to an accountant before, there's a lot going on in this tax law, and now is the time to go.
And when the Tax Reform Act was put in place, it was viewed that, wow, people will be able to file taxes and they'll be able to do it on a postcard. And so everybody was all excited.
A really big postcard.
A really big postcard. But I mean, really, that was a lot of discussion, with the raise of the standard deductions and everything, that so many people would not necessarily need to file, Schedule A and whatnot. But it sounds like it's a little bit more than being able to put it on a postcard.
Well, they did cut down quite a bit on the size of the 1040, and they made it one side of one page. But what they did to do that was they added a lot of schedules now that have to be added behind the 1040.
Yeah.
Well, my members will be glad to hear that. So, Paula, tell us your thoughts on this and what else you're hearing from your clients that causing them to stay up at night.
So I'll tell you that December is normally a pretty busy month for me. This December was probably busier than the average December that I've had in the last couple of years, only because planning is so important. So there was a lot of planning opportunities this new tax law brought to play. As we've heard both Brian and Scott say, contemplation of an entity. So at the beginning, when we heard it, I had a lot of clients come to me saying, I want to be a C Corp. I want to pay 21% taxes. That's all that they heard, because that was, a lot of the things that were being set out in the marketplace. Many people weren't considering the double tax, how much money they were pulling out of the company. So to kind of echo what was said already, now is really the important time. Is if you've never spoken to somebody, it's the time to really speak to somebody, because each situation really does differ. The response to each question does differ depending on the situation at hand. The 199A deduction is something very big for a lot of my clients. So I work with a lot of manufacturers and distributors. So they lost a manufacturing credit. That was another component in this tax law change. So, but the 199A brings that highest tax rate from a 37%, which is the new tax rate for an individual, to under 30%. So it is quite favorable if they meet all of these qualifications and these limitations. So a lot of my planning at year end with my clients was making sure that we were able to take full advantage of these different components and that the right pieces had put in place. The biggest planning opportunity I think I saw with a lot of my clients was something that we haven't discussed yet today, but as part of this new tax law, they changed the gross income test from $5 million to $25 million. So previously, if you had over $5 million in sales, you had to be an accrual basis taxpayer. And you had to pay tax on your receivables, even if you hadn't collected the money, and you had to, your basis of accounting had to be an accrual basis. That law changed, went from $5 million to $25 million. So that's a $20 million gap in there. As I mentioned earlier, a lot of my clients are between 5 and 50 million. So that, was really in my sweet spot. A lot of my clients fell into this window. So at year end, I sat with a lot of my clients and we looked at their receivables, we looked at their payables, looked at their facts and circumstances. And for a lot of clients, contemplation of changing or converting to cash basis, that was a very big planning opportunity because at that point, they're paying taxes based on monies that they had received and monies that they had paid out rather than on revenue that they had generated but not yet collected. It also gives them an opportunity for in the future to being able to manage better because they actually know what they're going to pay taxes on based on the cash that they had received in the bank rather than, anticipated revenue or anticipated collections, So that was probably a very big opportunity for a lot of my clients, and it required a lot of planning at year end in discussing with them what we needed to do, the best ways, the anticipated tax savings that we thought that it would bring in year one. And it really is a timing difference because the revenue is with the revenue, but it's based on collections. But that was something that I discussed with a lot of my clients, and it helped them to grasp it because most business owners, they're very good at running their business. They're very good at doing what they have to do. They're not contemplating, how it impacts the taxes that they're going to have to pay in April. So these conversations, it was very good and helpful to them and to me too, because I was able to explain to them the difference. And it's a lot easier for a business owner to know that he's paying taxes based on money that he had received versus money that, he was going to collect down the road. So that was a very big opportunity I saw.
Great. Let's stay on the planning opportunities. And Scott, what other opportunities are you seeing out there, or that you've had discussions with your clients, or about as it relates to the tax law changes?
Well, one of the things that people have asked me about is what to do about the fact that we really haven't gotten into the $10,000 limit on state and local taxes, but what to do about what their itemized deductions are going to look like over the next few years. And, what we always used to tell people was try to bunch your itemized deductions to get the largest bang for your buck. It's very difficult to do that now, but one of the things that is happening is that charities are being hurt because people are looking at their tax returns and saying, wait a minute, if I'm married filing jointly, I get a $24,000 deduction, standard deduction, and I'm not going to exceed that because I can only get $10,000 for taxes. My mortgage isn't going to bump me up another $14,000, even my mortgage combined with my charitable contributions. So what I do see people thinking about is the fact that they don't want to hurt their charity, their favorite charity. One of the things that they've been doing is contributing to something called a donor advised fund, which is a fund that allows you to make a contribution now and take the deduction for it, yet spread that deduction out over a number of years because you are working with the fund to tell them where you would like that money to be donated and when. So it is a way of continuing to bunch your charitable deductions to possibly get a deduction that's over the $24,000 standard deduction. That standard deduction, by the way, for someone who's single is $12,000. So that's one of the planning opportunities that I've been seeing.
Okay. Brian, any Any other thoughts on the planning
No, I
side?
think it's been a lot of what we've been talking about, and all related in my practice to choice of entity that we've been talking about.
One thing I'd like to throw out to the panel, I know we did a survey in the New Jersey Society of CPAs, reaching out to our members, asking them, how many of their clients had reached out to them regarding the change in the tax schedule, if you will, where people were getting more in their paychecks, and whether they were going to be folks were going to be surprised come April 15th or whenever they got their refund, and did you have conversations with your clients about that at all? I'll start with Brian, since
my clients are mostly not individuals.
Okay.
So
you wipe your brow and say,
completely, yes.
you won't be getting those calls about why is my refund not like it was last year?
Probably
Okay,
not.
well,
I don't prepare a lot of individual returns myself, but we have had the conversation, we meaning myself and a number of clients, about what they're going to do come April 15th. A lot of my clients they get 1099s and they never know what they're going to do on April 15th. But again, I have been telling my clients that if there's ever been a time to work this out and go to your accountant, now is the time. One thing, let me add, there is a penalty, as you may know, for underpayment of estimated taxes, which means if you're under withheld or you pay estimated taxes and you're under. And it's usually defined in the tax law as, and you can correct me if I'm wrong, I think it's 10% or $5,000.
It's the penalty. Yes, the penalty itself, yeah.
10% or $5,000. If you are using 199A on your return, it goes down to, instead of 10%, 5%. So you really have to be pretty accurate relative to your withholding come the end of the year, or else you're going to be penalized with the underpayment penalty.
So I meet with my clients at year end, as I mentioned earlier, pretty frequently. This year, I always prepare projections for them. So when I looked at their projections, it seemed like more and more clients were having estimation of bigger balances due come April, just because of those new withholding tables, and just because of New Jersey. So what I normally do with all of my clients is we have them meet the safe harbor. So the safe harbor is what it does is it ensures that you're not going to hit the penalty. So you're paying in, if you're at certain income levels, either 100% of your prior year's tax or 110% of your prior year's tax or 90% of your current year's tax. So as long as you've paid in that, even if you owe a significant amount in April, normally there's no interest or penalties. So at year end, I meet with every single one of my clients and we look at what their taxes. I always tell them, I hate surprises. So I hate having to make that call in April saying you owe this amount of money without them being prepared for it in advance. If we've planned for it, it's acceptable. But if we haven't planned for it, it's a no-no. At least, my clients think so. And what I saw in December was that, when I was working on all these projections for all these business owners, because I work on the business and the business owners, the relationship as a whole, is that a lot of them, the differences varied significantly over the prior year. And that's because the tax law, of course, and because their withholding tables, if they were on a regular salary with the same amount and it had just been adjusted based on the new tables, it wasn't covering all of the tax because of the different implications that New Jersey residents have with the limitations. So a lot of my clients, I had to have them pay in estimates in December, or I had to adjust their withholding on their final paychecks, and they weren't too thrilled because they were in a different situation than what they had anticipated.
Something that may be positive that just happened yesterday was that the AICPA, which is the American Institute of Certified Public Accountants, sent a letter to the Department of the Treasury, the Secretary of Treasury, and the IRS Commission asking for penalty relief for taxpayers for the 2018 filing season. And we'll see whether that gets any traction. But one of the things that they cited was the fact that these rules were very complicated, that the changes that had come out in the Tax Reform Cut Act, and that it took IRS and their staffs an inordinate amount of time to put the rules and regulations out. So we'll see where that goes, but let's all of us keep our fingers crossed. But by the same token, if you haven't touched base with your CPA, hopefully, or your whoever does your taxes, please do so as soon as possible, so you won't be in those situations. Because those are some real challenges out there. So, one of the hottest things that's out there is a recent Supreme Court decision on Wayfair, and I know it started to permeate throughout the country, and now it's somewhat cascaded down to New Jersey for some reason or not. Well, I'll start with you and ask if you could give us your thoughts on this new Supreme Court decision and what's going to be happening here in New Jersey, and then we'll go down the line.
Sure.
Okay.
So previously, most businesses thought that, they're just in New Jersey. With the internet sales becoming so big, they didn't think that they would cause them any filing requirement in any of the other states. What this Wayfair decision did is it changed the rules. It changed the rules that now if you are selling over the internet and you have a certain number of transactions or a certain dollar value in a particular state, in many of the states, this was South Dakota, right?
Yes.
So South Dakota passed that you now have sales tax nexus. So you now have to collect sales tax if you're doing internet sales to different states. And many states have adapted this already. Not all states have adapted this. But what it does is it causes a small business who might be doing business in New Jersey and thought that they were just enhancing their sales, increasing their sales by doing internet transactions, is now has administrative responsibilities to file in significant amount of states, causing them to have sales tax nexus in these particular states where before it was non-existent.
Scott, what are you hearing on this subject?
Sure. Well, I want to make it clear that there was always the obligation amongst internet buyers to pay tax on their sales. That's called, if it wasn't withheld, it's no longer called sales tax, then it's called use tax. As a matter of
I'm sure everybody
tax
did.
return always said, yes, I have stuff
Yes.
that I have purchased out there.
Absolutely.
and I know that every one of you did that, yes. As a matter of fact, I worked on an audit of a restaurant recently, where the little restaurant, the state of New Jersey, when it came to me, was asking them for $700,000 in back taxes. We managed to get it down to $23,000. But of the $23,000, $8,000 were use taxes. Why? Because I had to show the owner's American Express bill to the state of New Jersey to prove certain expenses were actually taken for the restaurant, but they used their American Express bill for everything. And the state looked at it and said, ooh, look at all those Amazon purchases. And they got hit with $8,000 of use tax. What Wayfair did, and what now the state of New Jersey is doing, is saying if you have over a certain amount of transactions and over a certain dollar amount, or over a certain dollar amount of transactions, you now have to withhold, which frankly might be difficult for some smaller companies that are just getting into this, but for the larger companies, it's probably not such a terrible result.
So one of my first assignments over 20 years ago when I was first year associate was about sales tax. And sales tax sounds boring, but I was fascinated and surprised by, I was whatever age I was, my 20s, to hear about the fact that if you don't pay sales tax, and I was working in Pennsylvania then, and people said, come to Delaware where you can buy without sales tax, that if you didn't pay sales tax on your transaction, you were required to pay it anyway as use tax. And it's interesting that over 20 years later, the U.S. Supreme Court has weighed in on the impact of this, because the really interesting, as we heard, this has always been the case. It was always the case for remote selling. It used to be the Sears catalog, whatever. But as the internet grew, obviously the states were losing huge sums of money. And the Supreme Court had previously ruled that this nexus standard required that the seller didn't have to collect sales tax unless they had physical presence in the state of the buyer. So that generally meant an office or employees or something like that. And it was clear that if all you were doing was selling on the internet, if you were a New Jersey business and all your employees and offices were in New Jersey and you were doing internet sales to other states, I mean, you would not have to collect sales tax in those states. And where this issue's come up in my practice a lot has been, and we do a lot of technology startups, the companies that are selling over the internet, or they have a service where customers are going to their website to get some service, which is often subject to sales tax as a software license. And that often surprises people. And so the clients would come after they said, I heard that I might have to have been charging sales tax. What do I do? And the first thing I would say is, well, it might not be as bad as you think. Where do you have nexus? And if they're only in one state, it's only the sales in your state that matter. And what Wayfair did was just upend this. And really the Supreme Court said, our old decision, which was called Quill from 1992, was erroneously decided. We were wrong. And I think they really were influenced a lot by the fact that the impact of the decision was that states could not have their sales taxes paid in large amounts. And so the thing that's happening now is, the South Dakota law that was upheld in the Wayfair case said that you have to collect tax if you have over $100,000 in sales in our state in a year, or 200 or more transactions. And the South Dakota law was not retroactive, so it would only go into effect when it was essentially upheld. They passed a law knowing it didn't pass muster under the old Supreme Court rulings, and something like 22 other states passed laws in anticipation of a Supreme Court case, very similar. So what the Supreme Court basically said, that law's okay. You no longer need to have physical presence in a state to have nexus, and that law's okay. Leaving open the question as to whether the threshold for sales or number of transactions should be higher in, say, a state like New Jersey, which has over 10 times the population of South Dakota. And so what this has now led to, I think, is both certainty and uncertainty, right? I mean, after the case came down, all of those, I think, 23 states that had laws on the books, those laws sort of went into effect, and as long as they copied the South Dakota law, they would probably stand muster. A number of other states passed laws after the case came down, including New Jersey, to follow the case. And so one of the real questions now is, so now that same situation where the client says, uh-oh, we haven't been charging sales tax, what do we do, is now it could be a much bigger problem for them. And just to even figure out where they have to collect, because we're a small startup, we have these internet sales. What do we do? It's like, we have sales into Colorado and Texas and Arizona and wherever. And the first question is, well, what's the law in that state? Yeah. And so to know if you have to collect sales tax now, the Supreme Court's not going to help you. You have to actually go look at the law of the state. And then, there's this question. And then it becomes complicated in all the ways. The reason that businesses didn't have to collect sales taxes before, part of the theory was it's burdensome. Why should you have to know? You're in New Jersey. Why should you have to know the law of Arizona? So it's, collecting sales tax, but it's what's the actual law in every state. And of course, I think the court basically said, well, you don't have to sell into Arizona. If you're going to sell, at least over a threshold amount, it's on you. And so these are the kind of questions that we're dealing with now. One of the questions that came up a lot right after the case was, is it going to be retroactive? Because basically the court said this, we were wrong before. So this is the Constitution allows the requirement that you collect, and that could have just been, it was just wrong all along, and you should have been collecting all along. Well, we don't know the ultimate. I don't know if it doesn't look like it's likely to be really tested going retroactive. The South Dakota law was not retroactive, and the Supreme Court explicitly mentioned that in the case as among the reasons why the law was upheld. So I don't know that we're going to have a problem with that, but most of the laws that are on the books now are not retroactive, but there is still uncertainty. So this is another area where I think businesses another reason to go to an accountant or a lawyer, because a business might be engaged in transactions where they haven't been collecting sales tax, where now they might need to do it, maybe on a large scale.
So this sounds like it would be really onerous on the small business community, particularly, with the use of the internet today and the fact that they may be doing So what do they do in a situation like that? I mean, I think in New Jersey, the law became effective November 1st.
Yeah, that's correct.
Okay. So, but I tried going on the site last night to see whether it was retroactive or not, and we should know this, and being that we're the CPA Society, but there was not really any clear distinction of whether or indication whether it was retroactive.
Yeah, and I think this is and it raises a lot of issues too, because if now you say, okay, now we're going to have to start collecting, but maybe they should have been collecting before,
right? Under
the old rules. Like now, it creates issues about should we try to get like an amnesty? Should we go, or should we just start collecting and just put blinders on to the past, and hopefully it was okay? It does raise a lot of those issues. It's interesting too that for many years Amazon fought as the states were enacting these laws to try to get more internet sales tax. Amazon was fighting in the courts. But then as Amazon got bigger and dominated the whole field, they realized it was better for them to collect tax when their competitors were going to have a problem. And especially because Amazon wanted to build warehouses everywhere, so they were going to have physical presence anyway. It is a burden on a small business, and it is possible that, and there have been some bills in Congress can override this to a degree and set a standard. But I think whatever the standard is, there are going to be some smaller businesses that get caught up in it, and it's hard to see that. I mean, people were trying to get Congress to pass a law before the Wayfair case to require or to allow companies to collect sales tax. Now we might see the opposite kind of incentive to try to get Congress to make this less onerous on small businesses. I mean, you could imagine exemptions for businesses of certain sizes. There have been proposals like that, but I, with the way things are going in Congress, I'm not sure that anything like that's ever going to get passed.
The other issue is that you'll have some states that say, well, we're going to go retroactive, and others that will say, well, we'll go prospective, and that just would be a nightmare for a small business to try to navigate all
right.
That.
And if you're a small business, are you going to say, well, I will challenge the retroactivity up to another Supreme Court case? I mean, it's not a practical thing to do for a lot of small businesses to say, because if a state goes retroactive, there is an argument that they're not allowed to under this case. And so the question would be, what do you do? And presumably you'll have to free ride because somebody bigger will take that case up, but that could take years and it's uncertain. So a lot more headaches for small businesses that do retail sales.
We talked about the SALT tax issue, and that we have a limit and everything. But any other thoughts on that subject? Because I know it's something that is a big concern. Because here in New Jersey, we have 4 counties at least that the average property tax in and of itself is greater than $10,000. So, what do folks do? What will we see as a result of that? Will we see people? Will the housing market start to decline? Will people start to say, maybe it's time to leave New Jersey and go elsewhere? I hope that's not the case, but we've seen a lot of discussion like that. I know we did a survey, and back when we were trying to get the estate tax exemption raised or either eliminated, that 81% of our members thought the estate tax caused individuals to leave New Jersey. And more importantly, I think which really struck home, 75% of our members said they actually counsel their clients as part of their wealth management or tax strategy to consider leaving New Jersey because of the tax structure. Do you think this SALT tax being capped at $10,000 from a federal perspective is going to, are we going to see an increase in outward migration? Paula, why don't I start with you and see what your client, because when this first came out, the one thing that was a surprise as our members started to talk about the Tax Reform Act and try to explain it, a number of one firm's clients started to come and say, is it time for me to move and to move my business out of here, given that? Give us your thoughts.
I'll tell you that I received probably about half a dozen calls last year asking, is it time to go? So that is definitely on the forefront of a lot of my clients' minds, especially a lot of them as they're thinking about succession planning, thinking about the next steps, what they want to do. When they look at other states such as, Florida, for instance, that doesn't have a state income tax and the real estate taxes are lower, a lot of them are contemplating, since they're spending significant amount of time in other states already, they're thinking that now is the time. And especially as the individual income tax, almost 9% now with that millionaire's tax, which throws on another couple percent. A lot of the individuals are saying they're not getting any benefit anymore. I have a lot of clients in Bergen County where the taxes are real estate taxes are extremely high. And I'm sorry to say this, Ralph, my recommendation is, okay, if you're no longer operating your business and you're spending a significant amount of time. So as an advisor, I feel that a lot of times I have to tell them that from a tax perspective, you may be better off moving, because a lot of your life is now outside of the state. So I think that we will see more of a migration out of state. I have seen, I would say probably about 3 of my clients moved out of state in the last year and a half. Personally, my family moved out of state in the last year and a half because of state income taxes. Even younger individuals. My sister is younger than me, and she moved to North Carolina in the last 6 months because of more opportunity and lower state taxes. I'd hope.
Paula, you can't move out, but at least maintain your membership in the New Jersey Society of CPAs.
I'm not planning on going anywhere.
You can be an out-of-state member.
I'm not planning on going anywhere. But I've seen it. I've seen it in my personal situation. I've seen it with my clients. Unfortunately, this has just been, I'm not going to say the straw that broke the camel's back, but definitely did add to that contemplation. I have one client that calls me almost on an annual basis to ask me that particular question. I go over the same facts and circumstances, and this year it seemed like it was the first year that it was leaning more towards doing it. So unfortunately, I hate to say it, but I have seen a lot more thought on that matter.
Winding down, so Scott and Brian, quick thoughts on SALT and what you're hearing from your clients or what they're asking you. Are they asking you about, is it time to move south, or is it? Interesting enough, most people think that outward migration, that most people are going to Florida and the South. The 2 largest states where New Jerseyans leave are Pennsylvania and New York, upstate New York, which is surprising, but based on the latest statement. I'm sorry, go for it.
Sure, thank you. I am getting questions about this. Should I move? What should I consider doing? There are a lot of people who can't move. So they have to stay here because this is where the work is, this is where their family is, whatever the case is. But I caution people before they make a rash decision to think through what it costs to move, because it takes quite some time in saved taxes to make up for the cost of moving. And the other thing that I tell people is just making up an example. If someone, I live in the town of Montclair. If somebody lives in Montclair and they've been in their house a long time, so they've paid their mortgage off, their taxes are $2,500 a month. Yes, they have to maintain the house, but there aren't a lot of places, especially once your earnings are not big. There aren't a lot of places where you're going to live in a place like that for $2,500 a month. So there are a lot of considerations that ought to go into whether or not people leave.
And I agree with that. And yeah, I grew up in Pennsylvania, and I am hearing about people moving to Pennsylvania because if your business, your office is in New Jersey, you can live in Bucks County, and the commute might not be worse than whatever you're doing now, driving through New Jersey,
Yeah.
and the taxes are.
All you have to do is go down to Trenton at 4 o'clock and see how many people going across the little bridge there.
Yep, yeah, exactly.
that work at the State House.
Exactly. Yeah, it makes a lot of sense. So, yeah, New Jersey, of course, was already a high tax state, but I do think that this limit on the deductions for individuals, they really feel it. Like there's psychologically, it's and they're going to see it now this year. What it does to their overall taxes. So maybe it will be for some people the straw that broke the camel's back, unfortunately.
Okay. I think we're at the point where we can open it up for questions from the audience that you may have about what's been said today. Yes. There's someone with a mic, so.
Thank you. I'll just give you context. I'm not a plant. I'm a Morgan Stanley advisor, so this is where the questions come from. Real quick, on Pennsylvania, I think they also don't tax the pensions there. So that might be another driver, but you guys, the CPAs confirm. I have a mix of corporate and individual clients, so I just throw out the themes and just get your thoughts. Opportunity zones, because that's at the nexus of like retail product. Morgan Stanley just came out, the first wirehouse with a fund. And that's a tax management tool. And then also getting under the pass-through. My business clients have been thinking of using a cash balance plan to defer into oblivion. I know IRS has issues with that. I wonder where that stands today. Maybe you have thoughts. And then bonus depreciation. It's not entirely new, but a lot of people don't know about it. So I have a comment for each of you guys, whichever sequence you want to take it. Thank you.
I'll take the bonus depreciation. So bonus depreciation, what that did is they made it, they now allow 100% bonus depreciation on assets that you acquire. So what that allows the business owner, if they need equipment, they allow them initial write-off right away. We always had Section 179 with some limitations. We still do. But Section 179 is limited to income. So bonus depreciation allows a business owner to buy equipment, finance the equipment, but take the write-off in year one. So it gives them some cash flexibility along with allowing for a deduction. So.
But on the state side, because we're not a piggyback state,
yes,
that bonus depreciation.
You have to add back.
You have to add back.
Yep, you have to add back on the state, and also on Section 179, you only allow $25,000. So you don't get it for state, but you do get it for federal. Opportunity zones, I don't know if
All I'll say about that, one of my partners has great expertise in opportunity zones, so it's not me, but it has become a very hot topic, and I'd be happy to put you in touch with her.
Other questions? Yes.
Two questions. One my husband sent me. Social Security trust. Can you actually take your Social Security and put it in trust? And I thought that was something. But the other one, you talked a lot about choice of entity. Can you change if you made the wrong decision before?
So,
can you change from S Corp if that's what you picked before to C Corp to S Corp if that's what you picked before?
yes, this is actually a really important question on choice of entity, and is one of the reasons I counsel people to be careful. If you are switching to C Corp, right? The general rules, they're complicated, but generally you can switch from a pass-through entity to a C Corp generally without any tax on that switch. But switching from a C Corp to an LLC can't be done without generally a prohibitively large tax, as if you sold your whole business and paid a double tax. So I like to tell people, and if you switch to C Corp because you like the 21% tax, well, with a new Congress and president, that might not be 21% for so long. And like I said, you just really can't get out of it. So going between S and C, you can do, but there's some limits. You can't just willy-nilly go back and forth. But going between C Corp to LLC is really generally almost impossible. So I would say if you're not sure about the choice of entity and you want to see how things go, it would make more sense to start out as an LLC rather than start out as C Corp. I don't know if anyone else has thoughts.
Well, I know we have a bill in that we were hopeful that would have gotten passed and been retroactive to 2018 on the pass-through situation, such that you could, here in New Jersey, deduct the taxes at the entity level as opposed to it being passed down to there. But that bill is still in motion, unfortunately, and therefore it won't be able to be retroactive for 2018. But I say that to say that one of our members actually wrote an open letter to the governor and legislative leaders on that, and they picked up on this and started to look at it, and it started to move, but then certain other things happened in Trenton that have taken the steam out of a lot of movement on the legislative side, like minimum wage and some of the recent hearings down there that have really stalled things. But hopefully we'll continue to work on that bill to get it through in 2019, so that we can have that effect, and that will hopefully address some of the issues. But we still have other issues there. I think the gentleman had a question here.
I have one back there. Here and then
Okay.
Just to continue with
to
continue with this choice of entities, can you talk a little bit about those that are excluded from the 190A deduction? Specifically, as an example, medical practices. You have a group of doctors. What can they do, if anything, to kind of almost blow up their existing structure to maybe benefit from some of the tax reform?
It is, for doctors in particular, and lawyers, accountants, it's very difficult to blow it up and have 199A, take advantage of 199A. One of the things we thought we were going to be able to do in the beginning, then the regs came out, was maybe for example, for a large law practice or a large medical practice, was separate out some of the other functions into a separate business and allow that business to operate as a business that might allow for the 199A deduction. But if there is quite a bit of common ownership, you're going to have a problem with that. It's really not going to work out. So Congress and the Treasury Department and their regulations were very thorough, and it would be very difficult at this point for doctors to take advantage of it. Now, if a doctor has a separate business, it's only as a doctor that they are excluded from 199A. If it's a separate type of business that is not in the medical provider space, for example, then that doctor might be able to take advantage of 199A.
There was probably too much written about this idea. So the
Right. Everybody went out and talked about this
Yeah.
idea, and,
Yeah. and
Treasury said, we're not going to allow that to happen.
Yeah.
question, the gentleman right.
Yeah, I have a whole bunch of questions, but I'll just start with two. So the first one is there was a lot of talk about a year ago about workarounds that New Jersey might be able to do.
Charitable deduction.
Using a charitable deduction, workarounds for the SALT limitations. And I'm just, talk died. And I guess my question is, what happened to that?
Dead on arrival.
Yeah.
IRS
Treasury
came
said,
out very strong to say, well, and there are some other programs out there in other states where they're doing that. And I'll say this, they're primarily small states and primarily red states. So if this idea were to go through, think of the impact on the Tax Reform Act, because it has a $1.5 trillion cap in terms of going over. If charitable deductions were allowed, that would bring in California, New York, Massachusetts, Maryland, New Jersey, Illinois, and that would essentially blow that cap up. And so it will go back. But IRS has come out and said, you cannot get a benefit as a charitable deduction for paying property taxes. So, there was a lot of Congressman Gottheimer, I think, was leading an initiative on that, trying to get that done. Several other members of our congressional delegation were also working on that. But the structure to do something like that, as I said, was going to be dead on arrival. The IRS commissioner came out very early on in the game and said, this is, that would not fly, basically. So there were some attempts even in New Jersey to put legislation up, but it hasn't moved. And I doubt if it really would move because, like I said, the IRS would just come back on that and push back very hard on that because of the implications. And because of the large states that would be benefiting from that and what that would cause on the federal tax side, I believe. So I'm sure that's not what you wanted to hear, but unfortunately.
Yeah.
Okay, and I have another question about entity type. So one of the things with the QBI and 199A is that I hear that you can take that for investments in REITs. And nobody talks about the BDC form, which is like a REIT, but could be used for manufacturing. And I'm really not quite sure what the rules are for other companies. Maybe you could talk, if you know, about whether the BDC form or entity could be used.
I think a BDC is usually a RIC for tax purposes, a regulated investment company. I would have to look. I know that the REITs get the 20% deduction without the same limits. As you know this, I didn't think that RICs were on that list, but I have to say this hasn't come up in practice.
Yeah. I know that there's been specific guidance on the different investment type companies. I had a client who's in the lending business, and they do just overall lending, like banking. And when some of the specific guidelines just came out, that was actually excluded, and it's not deemed a professional service, so they can't take the 199A. So I'd have to specifically look at that guidelines for that particular, for the RICs in that particular form. But I know that they've been very specific in their guidelines as to which entities can take it or not.
I mean, I'd be happy to follow up on that.
Question all the way in the corner there.
I'll use my words.
Okay.
It sounds a little like we're rearranging the deck, the chairs on the Titanic here with the tax law and assault and so forth. I'm a lifelong New Jersey resident. Ralph, if I heard you correctly, New Jersey is worse in the taxes right now in the union. And a recent report said outmigration, New Jersey is number one in outmigration. So I would ask people here in this rather than the panel, how many of you are thinking about moving personally or moving your business or expanding outside the state? Just out of curiosity. Because I've gone through that. Moved all my production out of state as of September of last year. I can't stay here and do what I do. So I just wanted to get a read from others here, personally, professionally, expanding or moving. All right, thank you.
Yeah, I mentioned earlier about one of our members who wrote an open letter to the governor. And that's what I suggest to citizens of New Jersey. If you're feeling like this is the place for me, you need to reach out to your legislators and let them know. Because otherwise, and I can share, when we were working on the estate tax issue back in, Don said 2016, it ultimately passed, but we were working on it before then. We did survey after survey of our CPAs because I believe that if you really want to know what's happening in New Jersey, reach out to the CPAs because they have their finger on the pulse of their clients and everything. And then you go to the attorneys and others. But we took those facts to leadership and the question was, we have more millionaires now than we've ever had in the state and whatnot. And I said, you know what? That may be true, but those are people who you're talking about the equity in their home and whatnot. But we also have those individuals that are leaving. It wasn't until David Tepper left and carried with him a $145 million tax liability to Florida. And just himself, and not including his business, that reality hit home about that, and that's what caused the movement on the estate tax. So I say all of that to say, don't sit back and just let things happen. reach out to your lawmakers, send them letters to say what the impact is going to be on you as an individual and if you're a business owner and that you're thinking about me. Because when groups like mine and others, NJBIA, the state chamber go and say that, they say, oh, you're just, you're the big trade association, and you're just blowing smoke. But when those individuals that vote here in the state of New Jersey reach out and with a letter and say, this is going to be the impact on my situation here, and I'm going to be thinking about moving, it starts to resonate a little bit. So,
One point, I'm a small $1.2 million business, so a small business by most definitions. But I refer to it as the Sutton Fund. Back in a century ago, there was a bank robber by the name of Willie Sutton. When Willie kept robbing banks, and one enterprising journalist once asked him, "Why do you rob banks, Willie?" He said, "What did he say? That's where the money is. That's where the money is." So that's why the businesses are getting hammered. It's where the money is, and this state has an insatiable thirst for that.
well, and again, I think, we've been pushing my organization for some type of incentives for small businesses because in the past, we actually have a bill in, what we call the Section 1202 bill, which provides special capital gains treatment for small and startup businesses that we're trying to get, the legislature to address because our feeling is that they haven't done a lot for the small business community. So, and we have in New Jersey somewhere between 350 to 360,000 small businesses. They're already here. We need to be doing something to keep them here and to help them expand their footprint. So again, I challenge all of you who have a feeling like this gentleman here to write your legislators and complain and tell them that they need to be doing something to keep me here and to keep my business here.
Thank you, Ralph. That makes a lot of sense. Paula, question for you. The regulations that have come out on rental properties to reach a trade or a business, I believe it's 250 hours.
Yes.
How is your firm going to handle Mrs. Smith that's got maybe 1 or 2 or 3 rental properties, works full-time? Is she going to certify to you that she's spending 250 hours a year in order to click that box, or how's your firm handling that?
The regulations on that came out 2 Fridays ago. So we have not addressed specifically the guidelines for exactly how we're going to handle it. But previously, I think there's other factors to be considered, number of hours, the total AGI on her return. There's a couple of other things to be considered in that particular circumstance. But because of the recency of the regs coming out, 2 weeks ago, we have not addressed exactly how we're going to consider that.
And one thing I would say about that is those rules will likely be similar to the real estate professional rules where 750, right. And the IRS has specifically said we do not require a log, just something that tells us the hours that you spent. Well, it sounds an awful lot like a log.
Yeah.
And if you want to be a real estate professional or you want to certify to the 250 hours, I suggest to my clients you keep an actual real log that says what property you worked on and exactly what you did.
I think as a firm, what we're going to do is tell the client that there's this threshold, not lead them by the nose to the threshold and say, I've reached that number, but advise them that if you don't, you lose this
Deduction.
Thank you.
Hi, thank you for this presentation. I come at this from a totally different angle than most of the people in this room. I do fundraising for a nonprofit, and I am wondering if you can clarify for me from the donor's side and for me to know as the person who works with the donor, what changes there might be in philanthropic giving other than DAFs, which it's a known quantity in the field. Are there other giving patterns that will change, and are there estate planning issues that are different than they used to be?
I think that just generally, I'm not an expert in this, but the standard deduction was raised. So for a lot of people who will be able to take the new standard deduction, they will not get any separate benefit from giving to charity, so their incentive to give to charity will diminish. Whereas for higher income people who are itemizing, they will still have the incentives that they had to give. I don't know if that means aim your fundraising at rich people, but maybe that always was. But I don't know if there have been any sort of reporting on what's expected as far as reduced philanthropy because of this. But there is more of a disincentive for some people.
And I would agree that your smaller donors, that's going to be a real problem over the next several years, which is why I mentioned donor-advised funds, for them to be able to actually get some bang for their buck every once in a while, yet spread the deduction out. But for higher income donors, I believe that the limitation, and you may know this better than me, went from 50% to 60% of your, is it adjusted gross income? So they can actually get a tax write-off for more of a charitable contribution. As far as estate planning goes, which is something we didn't really touch on, you still have gift tax issues when you make certain gifts to individuals. That doesn't really hit this area, but there's a lot of good reason. I don't want to spend too much time on this because we're going to run out of time. Well, all right, so let me spend just a couple of minutes on estate planning. People have asked me, one of the things I didn't mention before is, should I still do estate planning, considering that the federal exemption is $11,400,000, or for a married couple, it's $22,800,000. I don't know about you, I got that sitting right in the bank. And New Jersey no longer, at this point, has an estate tax. I would keep a close eye because I'm guessing at some point they're going to have an estate tax again. But they do have an inheritance tax. What's the difference? Very simply, estate taxes are taxes on assets that you have when you pass away. Inheritance tax is something that you have to pay tax on if you inherit property. In New Jersey, if you're a spouse, child, grandchild, parent, civil union partner, or domestic partner, there is no inheritance tax if you inherit something. If you're a sibling, son, or daughter-in-law, civil union, or domestic partner of a child, and everybody else, there is an inheritance tax, and it goes between 11% and 16%. But given the super high limits and no estate planning in New Jersey, why should you still plan? First of all, you want to direct where your assets go. It's very simple. Secondly, you may need a trust depending on your situation. You have little kids. Well, when I do a will for someone with little kids who has a reasonable amount of assets, I distribute those assets out over that child's lifetime, sometimes till they're 40 years old. Because what you don't want to do is you don't want to put all your assets in the hands of an 18 or 21-year-old. You may have a child with special needs or who has a drug issue or a child who would just take all that money and buy a new car. You want to be the one who is controlling this. Many of you are business owners. You want to create something called a dynasty trust, meaning you want to put money into a trust in such a way that it is for not just the next generation, but for future generations. This is all part of estate planning. People worry about gift tax. There's a $15,000 per person, $30,000 per couple limit before you actually have to file a gift tax return, but it goes to this $11,400,000 exemption. So most people are never going to have to worry about gift tax. There are a lot of things you can do with charitable donations, trusts that can be set up Some people have a favorite charity that they want to provide for. You can do it with an annuity. There are many ways to do this. But my point is, to keep it really short, that estate planning is just as important as it ever was. We just don't do as many things relative to taxation as we used to do.
So, final thoughts from our panelists, maybe. You have one more. We have time for one more question. Is there a question? Oh, okay.
I'm curious to get everybody's experience with the number of entity conversions from pass-through to corporation, and if you had many, what was the primary motive of those changes?
We've had a lot, but the primary motive has not been the tax law. What we see a lot of is companies that start out as LLCs, and they start out and they become tech companies looking for venture capital funding, and then they hire a lawyer, and the investors are looking for C Corps, and they can get the benefit of qualified small business stock. These are the kind of companies that are looking to get sold. So we actually do a ton of those conversions. The new tax law is just sort of, for them, since they would have been the kind of businesses that would have converted anyway, more of a motivator because of the lower C Corp rate if they do end up making profits. I don't know.
Yeah, I haven't seen all that many conversions. This law is still new, and people are waiting a year, 2 years to see where they're going to come out on it before they make too many decisions about converting. So I counsel my clients not to rush to judgment on this. Take a long, good look to see whether it's going to make sense for you to convert or not, because they don't realize, a lot of the smaller businesses don't realize the additional requirements that are going to be in place if you become a corporation that they don't have, a C corporation that they don't have if they are some other type of entity.
I have one client seriously contemplating it, but similar to what you just said, we've decided to just see what exactly comes into play. I think it's really facts and circumstances based, if they're going to draw money out in the next couple of years to consider the double taxation. But overall, I haven't seen too many entity changes, but there are a couple clients seriously considering it.
Thank you.
Okay. Well, before we get ready to do a wrap-up, just wanted to note I was playing on my computer here this morning and saw the NJBIZ morning roundup, and the top story of the day is that the Senate and Assembly, both committees there, approved a $15 minimum wage increase, and that will be going to a floor vote in both the Senate and the Assembly on Thursday, and it's anticipated it will pass, and the governor will sign it that day into law. So just heads up for all the small business owners out there, the folks that may be impacted by that. So, final wrap up. Any last comments or things that you want to impart to our attendees here today?
Sure. I want to say that I think it's extremely important to speak to your advisors. I know we all focused on it, we all touched it, but there are a lot of planning opportunities. And just to echo something that was said before, I did mention a lot of my clients, have called me, asked about migration out of the state, but I'd say 90% of situations they decided to stay because the opportunities in New Jersey have been a lot bigger than potentially in other states. So I joked about my sister leaving and me staying because the opportunities here for me and for a lot of my clients are really here with the New York City, with New Jersey, the business, the growth. I have seen a lot of growth in my clients here currently. And this new tax law just gives me more opportunity to really be with them and help them plan for the future. So I recommend that everybody really reach out to their advisors and plan, because there is a lot of planning opportunities out there.
And just a couple of quick things. I would echo that. I am not an accountant who advises people on this level, but I am recommending to everybody, particularly with a small business, that they go speak to some advisor. A couple of other things that we did not touch on. alternative minimum tax. And did you ever get caught up in that?
Yeah.
Yes. So the only thing I'll say about that is 2017, 5 million people got caught up in alternative minimum tax. Under the new law, they anticipate only 200,000 people will get caught up in it. So it's been changed drastically. Two other quick things. If your company does a settlement with somebody due to sexual harassment or sexual abuse, and there's a non-disclosure paragraph in that agreement, the settlement is not going to be deductible. The other thing that I would say is there was a change in the law for self-created property for you artiste types out there. It is no longer capital gain property. It is subject to regular income tax.
And I'll just echo what everybody said. There's just so much complexity out there. A lot of this is still new. Talk to your advisors, and there are lots of good reasons for staying in New Jersey, despite the tax system. So I'll leave it at that.
So before I bring Jeff back up, I just want if you give our panelists a round of applause. I think they did a lot of things. And hopefully you've benefited from something. I have my chief marketing officer here, and I just think we still have our public section on the website, right, Don? Well, but I mean in terms of if folks may have questions or want to see some of the things like 199A and things of that, they can go to our website. So www.njcpa.org. And if you don't find something there, pose a question and we'll try to get back to you with some answers on your particular question, or put you in touch with one of our members if you don't have a CPA that they possibly can help you. But again, it's been a pleasure to be moderating this event, and I really thank you all for your participation and the questions that you've asked today. And I would say, and I'll take liberty of that, if you have more questions, send them to NJBIZ, and we'll see about trying to get them answered by either our panelists or we'll find somebody out there who's a subject matter expert. Thank you.
Thank you, Ralph Thomas, and to our panelists, Paula Ferreira, Scott Novak, Brian Silikovitz. Thank you very much. I think I speak for everyone when I say we're all inspired to spend next weekend reading the 100 pages of the 199A deduction. So, or hundreds of pages. I meant hundreds of pages. Okay, well, that's the weekend after that. So just a couple of quick reminders. There'll be coverage of today's event on njbiz.com and in our magazine next week. If you're not an NJBIZ subscriber, you're entitled to a 16-week free subscription. You can see the folks at the registration table for that. If anyone is still left in New Jersey, on February 26th, we have another discussion on cybersecurity. I hope we all see you there. If not, thank you for coming, and I hope to see you all again. Thank you.